Okay, this is starting week 1 for our overview of this session, for this material, and how to do the homework. I'm going to have 2 separate videos. This one is going to be simply on kind of mastering this entry-level material, the Chapter 1, some of the most important parts. Hopefully these videos won't be more than about 15 minutes, 15 to 20 minutes at the most. And then I'll have a second video with just going into the My Accounting Lab and looking at some different examples on how to solve the problems, so to make sure nobody gets lost and doesn't know what to do. Okay, the first thing in this chapter, and then in accounting in total, is if you don't know this, the fundamental accounting equation, you'll never pass the class. This is something that you're going to have to memorize in order to get through this. Anything that happens in the business is going to fall under one of these 5 categories. Now, some textbooks stop after just the first 3. The assets equals liabilities plus owner's equity. The revenue and expenses, if you wanted to condense it down to the 3, would fall under owner's equity. I like to space them out and have them in their own categories. And know that eventually, as we get further into the semester, we're going to find that after the end of the year, these go away and they end up in owner's equity. So that's why some textbooks, especially at the very beginning of the semester, some will only show assets equals liabilities plus owner's equity, and then they just, by default, will put these in owner's equity. But I like to go ahead and get used to knowing that these are out there and a very important part of the accounting equation. Like any equation, it always has to balance, always. So, and you're always going to have at least 2 transactions for anything that happens in a business that you need to account for. So if something happens to the assets, one of 2 things then has to happen. Either something else has to happen to the assets and make it go the other way. So if you had a simple assets equals 10, and then your liabilities equal 8, then owner's equity would obviously have to be 2. If something occurred over here and you added another $4 of something, then either something's going to have to offset that to make it so it's still 10, or you're going to have to come over here and have a plus 4, or 0 and then a plus 4 over here, or even a plus 2 and a plus 2. Whatever it is, it has to equal what happened on the asset side. So if the assets go and interchange, they have a plus and a minus, then nothing net really happened to the assets, so then nothing is going to happen on this other side of the equation either. That's one of the big things we're going to have to remember throughout the entire course. And then when we start adding in these as well, the revenue and expenses, as you can see, I put the plus and minus in with them as well. So if something happens to revenue, it's usually going to be a plus to the accounting equation. And if something happens to the expenses, it's going to usually decrease that part of the accounting equation. Okay, once we get into week 2, I'm going to start talking about these key accounts. But we'll hold off on that until next week. Now what I wanted to do is go through and explain each one of these 5 categories and what's going to go in them. So your assets, you basically, anything in your business that you own or you have the right to own is going to be considered an asset. I have a sheet, and it's in the resources, and it's called accounts. And I'm going to bring that up in just a little bit. It's in an Excel document, so I'm going to have to wait and close this out before I do that and switch screens. But then I'm going to show you a list of all the things, or not all, but a partial list of things that a business could own or have the rights to own. So a few examples would be, and one of the biggest ones is your cash. Cash is a major asset, and usually if you have the cash, you own it. If you don't own it, then there's a problem there. Some other things that you own or have the rights to own. If you sell items out of your business and merchandise, we call that inventory. Typically, if you have the inventory, you probably own it. And we have another category called PPE, which stands for property, plant, and equipment, some of those large items in the business that you would own. Next is our liabilities, things that you owe. So you could owe quite a bit of things. You could owe payroll taxes from your employees. You could owe simple payables, like you have bought something like an asset, but then you have put it what we call on account. Like an account payable is a very common one, or notes payable. You could also have bigger payables like a mortgage payable. Mortgages, of course, are to pay off a home. You could have a car loan on there. Anything that you possibly owe money for is going to go in the liabilities. Owner's equity. Typically in this category, we're going to put items that any monies that the owner has invested into the business to help the business get started or to help it get bigger, that's going to go in this category. If the owner takes money out to pay him or herself, that's going to be in this category. And then, as I said at the very front, when we close out our revenue and expenses later on in the semester, hopefully the revenues will be higher, and then any of the amounts that is left that's higher, those revenues that are still higher than the expenses, that's going to end up in owner's equity as well in a certain account. The revenue section, well, that's if you did your job. If you did the business that you're set out to do. And in order for something to be a revenue, you have to meet two criteria. So the first one is you have to have the job paid or have a promise to be paid. So you don't have to necessarily have the money in hand, but somebody has told you, I will pay you when you get this done, and I'll pay you 2 weeks after. And they just say, bill me. And we call that an account receivable, because you're going to hopefully be receiving money that you have the rights to own. Therefore, you know that's an asset. So is the job paid? Do you have the cash? Or do you have an account receivable? And is the job done? You can't count something as revenue if the job's not even done yet. So the job has to be done and paid or promised to be paid. Then the last category is expenses. Expenses are usually smaller items that you have purchased for the business. They don't have to be tangible, meaning you can touch it. It could be things such as advertising. That's an expense that you are paying money for in hopes of building revenue later on. You pay wages. Those are to your employees. They're there to help you make money. You pay money for rent, to rent out a building in order to have a place to make money. Anything that you pay for that you get the benefit of for a year or less, basically less than a year, we're going to count that as an expense. So if you buy a truck for your business, a haul truck to move things around, you hopefully will keep that more than a year. Therefore, that's not an expense. That would be an asset, something that you own, and part of that PPE category, property, plant, and equipment, in that case being equipment. Now, let's go ahead. We're going to look at what debit and credit means. Again, we're going to look at that in week 2. I now want to pull up my Excel sheet and show you a couple of examples of each category. Okay, here we go. I have this in Blackboard if you wanted to see it as well and to have your own copy. This is just a very brief overview of some of the common items that you'll find in each of the categories. So things, remember, assets, things that you own or have the right to own. Cash being probably the biggest one. Your accounts receivable. Remember, that's if you have done a job for somebody and they owe you money, but they just haven't paid you yet, you got to keep track of it somewhere that somebody owes you money. So that's going to be something you're going to be receiving in the near future, hopefully, that cash. But you just don't have it yet, so you can't say that you have the cash if you don't have it. We'll talk about prepaids in a couple weeks, prepaid expenses. Inventory, most of us know what inventory is, things that you plan on selling in your ordinary course of business. Not all businesses are service-type businesses, say like an accountant is. An accountant or a lawyer is mainly service business. We don't really sell a product. But stores like Target or any other item place where you can go and actually get something tangible, they're going to have a lot of inventory on hand. And so when they have it on hand, they need to show that they own it. And then the final items down here in the non-current section are our property, plant, and equipment. Those would be our larger items, like our buildings, our vehicles, computers, things that we plan on using for more than a year, and that costs quite a bit. We might plan on using a stapler for more than a year, but that's not a really large item that we would consider an equipment. So we're going to place that somewhere else, generally in supplies, or we just go ahead and expense it because it's such a small item. It's what's referred to as non-material. It doesn't really make a big difference in our business whether we have a stapler or not. Liabilities, here are some of the common ones we're going to look at. Accounts payable being the most common right now. This is just if you owe money to a typical business, you probably will have account payable with them, and you will pay them off most likely within a month. And then whenever your employees work, and then if you don't pay them right then at the end of the work week or the end of the 2 weeks, you'll have wages payable set up because most people don't pay right after the end. They pay 2 weeks later. So for 2 weeks, you're going to have a wages payable. We'll talk about sales tax a little further into the semester. Unearned revenue, we'll get to that as well. Remember we talked about with regular revenue, you've had to have done the job and been paid. Well, there are times when you might get paid, you just haven't done the job yet. So remember, liabilities is you owe somebody something. And it doesn't always have to be money. In this case, you owe them a service. So that's telling me that one of the most common unearned revenues is gift cards. If you go and pay for, say, a Texas Roadhouse gift card, you give them $50. They can't count that as revenue until you've actually gone and redeemed it. They haven't done any work for that $50. Therefore, it's not revenue yet for them. And then we have the non-current ones, the ones that are going to be more than a year, things like a mortgage or a car loan or a student loan, those kind of items. We're going to go down there non-current. We call them notes payable. And the reason we call them notes usually mean if they have interest rate associated with them. And usually any loans that you have more than a year, you're going to be paying interest, and they require sign-offs and signatures, when maybe an account payable won't require that. Owner's equity, the three main accounts that we're going to look at. Capital, that's if the owner puts money into the business. Dividends and drawings, these are synonymous terms. So if you hear one, it means the exact same as the other. Capital is if you put money into the business. Dividends and drawings, you take money back out of the business. And then retained earnings is that final account where all of our revenue and expenses will eventually go to at the end of the year. We'll get to that in about 2 or 3 weeks again. So just know that it's there, but it's not important that we know exactly what it does. Revenues, we know what that is now. Hopefully you've earned your money and you have gotten the money, or you have a promise to be paid. And then here's some different types of expenses. There's a whole bunch of them. It could be really about anything. We don't like to use miscellaneous too much. We like to try to know exactly where we're spending our money and what we're buying and using to help grow the business. So we don't like to use miscellaneous too much if we don't have to. Okay, the last thing that I want to talk about, and this is also available to you in the resources. And here we are. What I want to look at is there's going to be some different tabs along the bottom. We're going to look at what's called the answers, and then ADG, which stands for Adjusted TB Trial Balance. This is what your homework is going to start you out with. What they're wanting you to do is see the overall, what we're trying to look at, what the end result is. And then going back to weeks 2, 3, 4, and 5, we're going to see how we get there. But here we're just seeing the final product, so don't be scared if you don't know how we jumped this far into the accounting. This is just seeing, this is our goal now, and then in the weeks 2, 3, and 4, or 5-ish, we're going to figure out how we get there. So these are the balances of all of the accounts in this business that I have made up and I use for my in-class people. We've got cash, and notice these are all assets at the beginning. Cash, accounts receivable, Steve owes me money. We got our prepaid accounts, which we'll talk about later. Supplies, this is like your pencils and paper that you have stashed away that you're going to get to eventually. A lot of your smaller items that you're going to use in the office maybe, or if you're like a plumber and you have different small tools that you, or maybe it could be just a whole host of things that are usually small and that you're going to go through within a year. I got my larger items, equipment. You don't have to worry about this accumulated depreciation quite yet. We're going to get to that in a couple of weeks. And then you see further down, I got the liability section. And notice these numbers off to the left. These are called the chart of accounts. And all liabilities are usually in the twos, so the 200s, the 2000s, however many accounts the business might have is where how these numbers are made. There is no really rhyme or reason. You just usually have your accounts payable up front in the beginning of the twos, just like how I had my cash and all of my current items that are small and are very likely to change within a year, when items like my piece of equipment probably won't change. So it's down at the bottom of the assets in the lower 100s. Got the liabilities, and then I come down and I got my owner's equity items, revenue, and then finally my expenses. And as you'll see here, one of the things that always has to happen is both columns always need to equal when you have a trial balance. And we're going to talk more about that in a few weeks. But now what I want to do is, using this information, we're going to begin to make the financial statements. The first financial statement that we make is called the income statement. And the income statement is going to use these bottom items, the revenues and the expenses. Basically, the income statement is telling us how much money did we make right now or for this year. So I'm going to go over here and click on the income statement. And you're going to notice when I do, I'm going to have a title at the top. And then my first account that I'm going to use will be this revenue. That's going to be my starting figure. Come over here to the income statement. All financial statements have this title, or they always have the company name, whatever company it is you're dealing with, what financial statement you're working with, in this case the income statement, and then they have the period that you're dealing with. And you'll notice for this one and the next one we're going to do, they say for the year ending or period ending, or they could say as of. But that's to say it's just for this current year that we're talking about, just for 2015. And so that's my revenue is not going to include 2014 amounts, 2013. It starts over every year. And so I made $20,800 in profit, or in actual bringing in revenue. And then I spent all of these expenses. So I paid some money for advertising, which will help grow my business. I paid for some rent, wages, and then an item we'll talk about in a few, 3 or 4 weeks, depreciation. These are all items that cost me a little bit. And so I added those up. That's where I got the 15.8 from. I added all of my expenses. So then when I take my revenue less my expenses, I get a very important number in accounting, your final net income. It's kind of like your net pay on your paycheck. Your gross wages is never what you really see. You always subtract your wages minus the taxes. In this case, they're the expenses. And then what did you actually take home? And this business earned $5,000. So there are 3 main financial statements that we're going to hit this first week. The income statement, which tells us how much money we made, the statement of retained earnings, and then the balance sheet. Every one of those numbers that we saw on the trial balance over here will be used. So if it kind of helps you, you may want to go ahead and highlight or somehow show, I have now used and accounted for these bottom items, the revenue and expenses. I'm not going to use them anymore. And one of the things with the financial statements, they all have to interconnect. So the income statement will flow into the retained earnings, and then the retained earnings statement will flow into the balance sheet. So that's the next step I'm going to be doing, is I want to flow now my income statement, my final number, this 5,000, into the statement of retained earnings. So as you see, the first thing you always do is have your proper title, name of the company, what it is, and for the year ended December 31. The statement of retained earnings generally only has 4 items happening. You take your beginning retained earnings. So I go back. My beginning retained earnings was right here. I started out the year with $11,000 in overall profits for the past years. Retained earnings continually builds on itself where these guys go away. Retained earnings started with $11,000, and then to tie in the income statement, I add in the net income, and then you subtract out your dividends, and you'll see that the dividends here were $3,000, so I can get rid of that one. I've used it. Subtract out your dividends or your drawings. Then I just combined those two amounts. So we increased overall profit in the business by $2,000 after you see what we made minus what the owner took out for himself out of those profits. And we increased the business worth $2,000. So my ending retained earnings number will be $13,000. I started with 11 and now I'm at 13. And it's this number that I'm going to carry forward and connect to the balance sheet. So let's look at the balance sheet. Let's just start with the asset side first. The balance sheet has all of the remaining accounts left that we haven't used yet from the trial balance. Again, we have our proper title. The main difference is, notice the date. It does not have for the period ending or as of. It's just at this date and time, on December 31, 2015, this is what the business had within itself. We had this much cash. That doesn't mean we had just that much cash for this year. That's our cash forever and ever. That's where we have gotten to, the $23,000. And if I look back to my trial balance, that's what the cash is, $23,300. And I'm going to want to use all of these assets, all of these current assets in my balance sheet. And that's what I did here. AR, prepaid expenses, supplies, and I totaled them out. So I got total current assets. So I'm just listing my assets and getting a total. Next, I get my long-term assets, equipment, and my other piece of equipment. These, again, we'll talk about later, but basically what that is some of the equipment has been used, so I'm taking a little bit of the value away. It's a real simple explanation. So in total, when you take a little bit of their value away, I have $10,000 left in my books for my non-current assets. So when I add up the total for all of my assets are worth $37,500. That's an important number that we're going to see again in a minute. $37,500 total assets. Now I come over here, and if I go back to my trial balance, the only items that I have left now are my liabilities and one of my owner's equity. So this is all that I have left to account for somewhere in my financial statements. So I'm going to do these first, well, all of them actually, because they're all current liabilities. None of these are long-term because they don't have the word note or something similar associated. So I go back to my balance sheet, put all of my liabilities here. Add them up, I got $9,100 in liabilities that I owe. I owe people money to the tune of $9,100. The final item that we have is our capital that we haven't used yet. So now everything should be yellow because we are now going to use the $15,400. And then we have what we consider the connector. This is the item that we just determined in the prior sheet, the retained earnings, the new updated retained earnings. I'm not using the old number because I can't use it again, the 11,000. I have to use that new 13,000 number that I just got that's going to be my connector. It's going to help me connect all three sheets. So that retained earnings is going to go right here, that new number. And then I'm going to have total owner's equity. When I add up my owner's equity plus my liabilities, I get 37.5. So if we go back to the original accounting equation that we just started out with at the beginning of this lesson, assets must equal total liabilities plus owner's equity. And you see that they do. So that's our check to see if we got it right.